Well, good afternoon, everyone. This is our second in a series of our second series of programs showing you some of the ideas of the Jewish National Fund. And this one is a special one. We're in an interesting time. I was watching CNBC this morning as I woke up, and I noticed that the interest rates have again fallen a little bit, where the 30-year US Treasury is under 2%. The 10-year Treasury is about 0.5%. And what we're finding out are that our donors are looking for ways that they can earn some income in a safe and conservative way, as well as be our supporters and help Israel through the Jewish National Fund. So just a little bit about a history about our charitable gift annuity program. Has been going on since 1969. It is one of the largest gift annuity programs in the country, either Jewishly or non-Jewish, if I could say it that way. We're servicing well over 2,000 contracts, which are represented by just over 1,000 unique donors, which means to me that people are doing repeats because they work so well. So normally, when we have a program such as this, we search for an expert, outside expert, to talk with you, like we had last week in Mark Horowitz. But this week is different because we are the experts in this. And I'm going to turn the program over to two of our plan giving directors, Cynthia Hazami, who is our plan giving director on the West Coast, Robin Dermer, who is our plan giving director in Florida. And joining on the call is myself. I'm the Chief Plan Giving Officer, and Bill Adolph, who is our Plan Giving Officer in the Midwest. So I've reviewed the program. I think you're going to get a lot out of it. If there are questions, just bring them up on the chat, and we'll try to answer as many as we can. Want to thank you for coming and joining us. I think you're going to get a lot out of this program. So I'm turning it over to Robin. I guess you're up first.
Okay. Hi, everyone. Thank you so much for being on the call with us today. I recognize some of the faces, and I'm happy to see you again. And welcome to all of those who we don't know yet, who we hope to come to get to know in the future. We appreciate you being here with us. And as Matt said, if you have any questions throughout the program, please type it in the chat feature, and either Cynthia, myself, or someone on our plan giving team will answer them when the program has concluded. So to begin, a Jewish National Fund charitable gift annuity is a simple, cost-effective estate planning tool that benefits both the land and people of Israel and you, the donor, throughout your lifetime. A charitable gift annuity gives you dependable, consistent, fixed income for as long as you live. And it also ensures that you have the nachas of knowing that you're making a difference in the lives of so many people in Israel by supporting our homeland. A charitable gift annuity with Jewish National Fund is created by a simple contract between you and JNF, where depending on your age and the size of the gift, Jewish National Fund promises to pay you, the annuitant, income for life. It's perfect for people who are risk adverse, or people who get agitated in volatile stock markets, or people who are looking for comfortability and security at this stage of their lives. Some of the people that I work with, they don't want to have the responsibility at the later age of managing their portion of their assets. So a charitable gift annuity eliminates any money management responsibilities while providing a secure, high investment return for the remainder of their lives. Despite the simplicity of this concept, a gift annuity is a powerful vehicle that can be used in a variety of situations with people with a wide range of economic circumstances. So just to give you an example, I work with a donor who is a Holocaust survivor, And what he does, like Matt mentioned, we have a lot of donors who are repeat donors. He ladders his gift annuities to ensure that he has the income to help supplement the care expenses for his wife who has Alzheimer's. So this is the way it works. I don't know if I have the point feature here, but basically the donor makes a tax deductible gift to Jewish National Fund. In exchange, you receive the guaranteed income for life. And then once the person passes on, the residual value goes to support Jewish National Fund projects in Israel. The gift annuity is a source of regular income. And since we don't have a crystal ball on what the future is going to bring, it's a way for people to prepare for the future, not only for themselves personally, but the future of our homeland. Some people call gift annuity a win-win arrangement because you can earn up to 9% income for your life, and then you receive 100% of a nation's gratitude by creating a legacy after you're gone. Lifetime payments, like we said, depend on the size of the gift and the age of the annuitant. And as you can see here, we have a chart with ages and current rates. The rate will never go down. What you see is what you get at the time that you make your contract. And you get the charitable deduction in the year that you make the gift, regardless of when you start receiving the income. So as you can see here, an example would be Donna Donor, a 78-year-old who creates a $10,000 charitable gift annuity with Jewish National Fund. Her rate of return would be 6.4%, and she would receive an annual distribution of $640. The rates, as you can tell, are super attractive, but the effective rates are even better because of the tax-free income. Plus, you get the tax deduction in the year you make the gift. So here's another example. Donna Donor funds a charitable gift annuity with $25,000 cash. She would receive 7.4% if she's taking the income immediately. The annuity would be $1,850 annually for her lifetime. That does not go up, it does not go down, it stays consistent, of which $1,613 would be tax-free income for the first 8.3 years. And then after that, the amount would be taxable, and she would receive a charitable deduction of $11,611. What we do is we create illustrations for each individual person. So this is just an example. If you wanted to have a personal illustration, we can create it and show you to the penny of what's taxable, what's not taxable, how long the tax-free income would last, and what your charitable deduction would be. Finding a strong interest rate in a low interest rate environment is definitely possible. I know Matt mentioned that the interest rates keep going down, but if, as this chart represents, if you compare a charitable gift annuity with a CD today, you're earning over 10 times the amount each year. It's not only tax advantaged certainty of income, but you're also leaving a legacy, and you can't put a value on the legacy that you're leaving. With a CD, yes, you get your principal back, but with a charitable gift annuity, you're leaving your values behind, and that's priceless. I lost my dad last September, and I can tell you that the most important thing that he left me with was his values, his love of Israel, his work ethic, his sense of humor, his appreciation of music. So sometimes, you know, it's not just the dollar amount that you're going to be receiving. You need to, or people, I think, have to look at the bigger picture, and a charitable gift annuity allows you to do that while receiving the consistent fixed income. Many people use charitable gift annuities strategically. Obviously, we all know that diversification is the name of the game. It's like location, location, location. We all need to be diversified in our investments, and there is no one size fits all plan for anybody. So our plan giving department works with people to help create a personalized plan that meets the unique needs and goals of each of our donors. You can set up a gift annuity that's deferred to ensure that you're receiving a fixed retirement income at a predetermined time in the future, such as when you get ready to retire or when you think you're going to wind down. And by doing so, you're actually putting a portion of your fixed income on autopilot. And when you defer, two very positive things happen. Number one, the longer you defer, the higher the interest rate. And also, the charitable deduction goes up the longer that you defer. So just with this example, if Donna Donor at 65 created a charitable gift annuity, her rate would be 4.7. And that's if she took her income immediately. If she defers until she's 70 years old to receive the income, then her rate jumps to 6% with an annual distribution of $1,200. You can set a predetermined deferral date, or if you're not sure, because we don't have a crystal ball, we don't know what life's going to bring, you can choose to have a flexible charitable gift annuity. And that would allow you to determine the date 90 days before you're ready to take the annuity. So you still get the deduction in the year that you decide to do the gift, but you know for certain what your rate is going to be at any particular age. So what we would do is you would let us know, well, maybe I would want to take it, sometime between 2025 and 2030. So we would give you the dates, we'd give you the rate based on the age that you're going to be when you start. And then you would see the tax-free portion, the ordinary income, and you can make a determination as you get closer to that date. So you're not locked in to a specific deferral time. You would just need to let us know in writing 90 days before the election date. So whether it's an immediate gift annuity, deferred, or a flexible gift annuity, you can create it with 1 or 2 lives. In a 2-life annuity, what happens is if something happens to the first person, then the second person would receive the annuity for the rest of their life, and then it would go to support the land and people of Israel. The rate typically, all the time, the rate is lower if it's a 2-life annuity, and that's because we're guaranteeing 2 lives. So this is an example here of Donna Donor and her husband funding a gift annuity with $25,000. Their rate for a 2-life would be 6.4%. The annuity would be $1,600 for their lifetime, of which $1,044 would be income tax free for the first 10.8 years. That would be until they're 92 and 94. And they would also receive an immediate charitable deduction for $13,714. A 2-life annuity can be deferred, and it also can be flexible. If you're providing for someone else and you want to be sure that they're receiving a fixed income should something happen to you, and you don't want to create the annuity now, you can always do it through naming the gift annuity as a beneficiary with a beneficiary designation, or by naming it in a bequest, in a will, or in a trust. You can accomplish your goals by doing this now for the future. The numbers, the amount of the annuity and the interest rate will depend on the age of the annuitant and the annuity rate that's offered at that time. It's a great tool to provide supplementary retirement income to support someone else. And you can give a specific dollar amount, you can give a percentage, or you can even name an asset such as a stock to fund the annuity after your demise. And just some notes, the minimum donation for our charitable gift annuity program is $5,000. Like we said, it can be funded with cash or appreciated stock. The additional benefit, if it's funded with appreciated stock, is that you're able to spread out the capital gains and defer some of the capital gains tax on that appreciation. The gift annuity avoids the volatility of the market by providing consistent, dependable income. Payments are direct deposited. It's the donor, the annuitant's choice of whether you want to receive your income annually, biannually, or monthly, and it gets put right into your checking or savings account. You become a member of our wonderful Good Legacy Society and other Jewish National Fund giving societies. And like I mentioned earlier, comparative illustrations can be easily created. It's a very personal, customizable program, and we encourage everyone to reach out to us and let us work on an illustration for you. Thank you.
Robin, it's
Yes.
can you go back a couple of slides to the Donna donor slide, the comparison between the CD and the gift? That's
Right
really,
here.
yeah. So well, Robin, I just wanted to make sure that we zeroed in on some of the benefits. And the reason I say that is that comparing a gift annuity to a CD might not be valid, and that, as Robin mentioned correctly, a CD has a maturity date and you're going to get your money back. A gift annuity is an irrevocable gift. You don't get the principal back. However, and this is something we're running into daily, which is why we're doing so many gift annuities these days, is that interest rates are the lowest. Well, they're zero. You can't get any lower than zero. So what I wanted to do was bring to your attention on this, what the results are for a donor, strictly from a financial point of view at first, as to why this might be considered as an alternative to maybe somewhat I would call commercially available investments. So we have an 82-year-old, our rate is 7.4 on a multi-year CD. Maybe you'll get one, in this case, we illustrating 1.05%. Well, we're all smart. We all went to school. We know that 7 is more than 1. So the annual income is greater. But here's what happens when we use an annuity with a cash contribution. A good chunk of the income that you're going to receive over your life, over your actuarial life expectancy, is tax-free. So in this case, based on today's factors, of the $1,850, $1,613 of it, you're not going to pay income tax on. That leaves you with $237 of taxable income. At this tax rate of 37% combined federal and state, the after-tax income is $1,762. Compare it to the after-tax income of the CD, and you're greater than 10 times the income every year. So we're looking, we do know that when we talk with donors and we talk about investment planning to the extent that we can, we know that everyone needs income or money somewhere, earning income somehow. And this does it. I call it indestructible. It's guaranteed by the Jewish National Fund. Our assets exceed our liabilities by a factor of 9 or 10. So we know it's safe. And on the annuity, what you don't get on the CD, you get an additional $11,000 tax deduction, in this case, saving an additional $4,200. So as Robin said, but it's also, what is your money doing? It's your values. Yes, you don't get the money back, but yes, you're being compensated both tax-wise and income-wise for a long period of time. So one can make I believe, one can make a very good case financially that this, I believe, is better. And when you consider that the balance of what is left at the time the money is no longer needed comes to the Jewish National Fund, that's a win-win. So all of the permutations that Robin spoke about, the 2 life, the flexible, they all act in the same manner. And so we can show you some terrific benefits, as well as, what this does for the land and people of Israel through our work. So that's all. I wanted to make sure that we zeroed in on the financials. Are there any questions?
Thank you, Matt.
Matt, actually, I think there was a question about the rates. Do you want to comment on that?
Yeah, what was the question?
Are the rates set?
How are the rates
Why are
set?
some organization rates more than others? Is there a
Okay.
way to get a higher rate if I go with Jewish National Fund?
Okay,
That's the question.
so the way the rates are set, through, we use a choice of annuity rates. And some organizations will be lower than us, and some organizations will be higher than us. We have gone through a period where we have lowered our rates a couple of times because interest rates on the outside have gone down. I also manage the investment committee, so I know exactly what's in this thing, and I know exactly what we need to do in order to keep the program viable. So the answer of the questions are: the rates are set, they're fixed. If interest rates go up to an amount, we might change our rates and increase our rates, but that is only for new annuities. It does not affect existing annuities. So if you did an annuity today and you got 99.0% and interest rates had to go down further, your annuity is fixed. If it goes up, your annuity is still fixed, and if you want to do another one, you could always add additional ones and get additional income. Does that answer the questions?
That was one question. And another question that came in is, can you discuss what happens when the money goes to JNF at death? And is there an additional benefit to the donor or spouse?
So if you have created which many do, a 2-life gift annuity with a husband, wife, spouse, whatever you want it is, the income continues unabated in exactly the same manner until the survivor of the two of them, it's called joint and survivor, passes. So sometimes we have a husband and wife or two people that with a disparity in age will take 2 individual gift annuities. You just need to know that in that case, whenever one of them passes, that income would stop because the annuity matures at death. So you got a choice. Do I take a lower rate, but we'll spread it out over a longer time? Or do we take a higher rate and take the risk that one might pass on before the next and their income would stop?
Well, and I just want to add, and when one, if it's a 1 life or both pass on, then whatever the residual goes into the general fund of Jewish National Fund. However, you can say that you want it to go to a specific program area, not a project, because nobody knows what's going to be at that time, but certainly one of the program areas, if that's your choice. But as a general rule, it would go into general support. And I think that's maybe what
there was
asking as well.
another question, Matt. Is there a target age that's the best for
Yeah,
ROI?
I always ask that. That depends on what we're paying you, and that depends on what you think you might be able to earn on the outside world. As you can see, the younger you are, the less you get. I believe that they start to make sense on an immediate basis where the income comes to you immediately at 65 and above. On the deferred that Robin mentioned, or the flexible, we have entertained and created annuities for people who are younger because we're deferring the beginning of the payment, maybe 10 or 15 years, and then that begins to make sense when they begin to receive the income. So it's different for everyone. It's a question of how old you are, how comfortable you feel, what's your risk tolerance, do you only want a whole bunch of questions.
And what your goals are.
What your goals are. So that's the answer to that question. But on a rule of thumb, for a single person, 65, if you're 64, we'll consider it. It gets to a point sometimes that you have to honestly say to yourself, I think I might be able to do better somewhere else, and I'll make my contributions outside of that. That's just being upfront with you.
I'm gonna, we'll do one more question and we'll get to the next part and
Yeah.
open it up again. Can you take the money out of for an RMD for a charitable gift annuity?
Good
The
question.
answer to that is a flat out no, by law. We keep the charitable lobbying group is consistently lobbying Congress to allow that, but as of now, no. By law, the only thing you could do with the RMD to a charity to avoid the taxes is give it outright. Okay. Cynthia, you're on.
Yeah.
Hi, everyone. Thanks for joining us today. Thanks, Robin, Matt. This was great regarding the annuities. So one of the questions that has been really coming up for us lately is the issue of two tax laws that passed in the, not passed, but became effective the first quarter of 2020. And the one that we're going to talk about today is called the Secure Act. And the goal of the Secure Act really was to increase options for Americans with respect to their retirement assets and to ensure people had enough money to last through their retirement. However, and one of the things that happened, and it was a bipartisan law that passed. I mean, Democrats, Republicans both agreed on this. And what they agreed on is that while they're willing to extend the minimum the age for RMDs goes from 70 and a half to 72. So you get an extra year and a half to put some more money aside. You can actually continue to make distributions into your retirement account even after that age if you desire. So that gives you a little more time to build up your retirement account. We kind of talked about, Matt had a question about the IRA charitable rollover, which is basically if you want to make a gift to a charity and you don't want to pay tax on your IRA or retirement assets that's been sitting in this bucket, not being taxed for decades, that is a great pot to make a charitable donation. But what the Secure Act did is Congress has decided that rather than letting these assets, these retirement assets, be something that you leave to heirs, they have indicated it's time to stop that it's time to tax the assets. And you have to think, this could be decades, literally decades. You've been putting pre-tax money in a bucket. The bucket's been growing and appreciating with no tax has been paid on it. It eliminated the stretch provision provided for inherited retirement assets. Can you go to the next slide, Robin? This guy, Ed Slott, is actually a pretty well-known financial planner and specializes in retirement assets. And I think he hit the nose on the head when he said, Congress has made a calculated decision that they're putting a stop to making this asset an asset that your heirs should have and use over their lifetime. Instead, they want you to use it over your lifetime. And there's been studies that show in 10 years, between now and 2030, the US government is expected to collect $15 billion on this issue. And that money is yours. So of course, you have to start thinking to yourself, what am I going to do about this? You could definitely try and drive down the value of your retirement account. You could give it away. You could definitely give your entire account to charity. But if you want to benefit your kids or your heirs or your loved ones, we have some suggestions for you. Can you go to the next slide? So Congress has indicated there are some exceptions. And I guess I should back up a minute, because if you had an IRA in 2019 or before, and the beneficiary were beneficiaries were your kids, I'm just using kids as an example, or niece, nephew, loved ones, whoever, they would be able to stretch out taking the distributions, just like you take RMDs now, they would be able to stretch that out over their lifetime. So if you have a 35-year-old beneficiary, that person gets to stretch out the distributions, if it was before 2019, 45 years. That's incredible. That is no longer the case. If you are a spouse of the decedent, you can either roll it into your own, a spousal rollover into your own IRA, and it acts just like a regular IRA. You can continue to be the beneficiary of the IRA, and then you just start taking the RMDs, the required minimum distributions, whenever the decedent would have had to start taking those RMDs. If your beneficiary is disabled or chronically ill, there's an exception. If it's maybe to your sibling or a friend who's less than 10 years younger than you, also there's an exception. And finally, a child does get an exception. If you pass away and your child is under the age of 21, they get to start deferring it over their life expectancy until they hit the age of majority. So it's not a great situation. So what are we going to do about this? I have some ideas. So obviously you can, I mentioned designate the beneficiary, use the IRA for the IRA charitable rollover, but what if you want to minimize your taxes, have a little control over the funds during your heir's lifetime, and make a decision about where that money is going to go in the end to support your legacy, to support what you care about the most. And I kind of like to call these funds social capital. You can decide to give the government your money. You absolutely could do nothing and give the government your money, or you could take your social capital and make sure that you're making a difference in the world and a difference in Israel, our Jewish homeland. So I'm going to give you an example, and then we're going to go through some numbers just to show you how this works. Judith is a woman who has one daughter named Sarah. When she passes away, Sarah is 65 years old, and Judith's IRA is worth $1 million. So if she designates Sarah, which she does, as the beneficiary of her IRA, Sarah is going to have to take out $1 million within 10 years. She doesn't have to split it up $100,000 a year. She actually could take it out slowly, quickly, at the very end. She could, it might depend on her income during certain years. She could make decisions based on that. But another thing that she could do, if Sarah's goal is to defer paying tax, defer giving the government her money over a longer period of time than 10 years, what Judith could do is make the beneficiary of her IRA either a testamentary charitable gift annuity, just like Robin mentioned before, meaning when you fill out the form, I think everybody has seen those forms for their retirement accounts, rather than naming Sarah individually as the beneficiary, Judith could have named a charitable gift annuity with Jewish National Fund. Or she could also name a charitable remainder unitrust with JNF. We often serve as the trustees. I'll get into that a little later, and maybe Matt can talk about it, of a CRT. And the difference really is going to depend on a couple things. A, the age of the child or the heir at the time of the person's passing, because the gift annuity, as Matt mentioned, is best utilized when the person is 65 or older. The CRT, I call it a charitable remainder trust, gives you a little more flexibility in terms of beneficiaries, the ages of the beneficiaries, timing of the gifts, taxation of the distributions, and that sort of thing. Can we go to the next slide? So say Judith passed away when Sarah was 65. The date of the contract is going to be the date of Judith's passing. And Sarah is going to inherit this gift annuity of $1 million. Sarah's going to receive $47,000 every year for her life. If she dies 10 years later, 20 years later, 30 years later, it's not going to change. She will receive $47,000 every year. In the end, Jewish National Fund will receive approximately a minimum on $218,000. It could be more, it could be less. It kind of depends on the investments. But at the minimum, JNF would receive $218,000. Can we go to the next slide? Robin, the next slide. Oh, thanks. So with the charitable remainder unit trust, assuming a percentage of 5%, meaning the distributions are going to be based on 5% of the value of the trust each year, which is going to be valued every year on January 1. So if the trust value goes up, it'll be a little more. If it goes down, it'll be a little less. And, you know, these are obviously illustrations, and we're sort of approximating the growth of the value of the trust. But basically, Judith's not going to pay estate tax. She gets to bypass income tax on this asset, because when you have a retirement asset, it counts within the estate, and they could pay income and estate tax on it. Sarah's estimated lifetime income over 20 years is $748,000, but it could last longer. I just used 20 years so that we could all be uniform, because I'm going to show you in the next slide another example. But so she would receive approximately $748,000, but then at the end of Sarah's life, because of compounding interest and because of the growth in the investment, Jewish National Fund would be left with $1.2 million. And so go to the next slide. So what happens if Judith decides to leave the asset, makes Sarah, the individual, the beneficiary of her IRA? So you still get to bypass the income tax. You do get a partial estate tax deduction. But then Sarah's going to take that money, and she will need to take distributions out of the IRA, all of it actually, within 10 years. If she takes it out slowly over the first 10 years, she's going to get about an estimated lifetime income of about $355,000. Then if she takes the lump sum in the 10th year, she still has to pay her income tax on it. So maybe she's left with another, I can't remember now, a few, $400,000. She's going to invest that. Let's pretend she invests that. Over the course of 20 years, she's going to get $622,000. The remainder for Sarah's heirs, whoever she decides to leave this money to, is going to be $821,000. So go back to the CRT, Robin.
Sure, one sec. There we go.
So you can see that those numbers really make a difference. Sarah's getting a $748,000. The other thing about the charitable remainder trust, unit trust distributions, is the tax on Sarah's distributions year to year will be at not her income tax rate. It'll be a blended rate, which will be a little lower than her income tax rate. So she gets a tax benefit on the income tax, and she gets more money over the course of her lifetime, which is pretty significant. And if Judith's goal was to leave a legacy to Israel, and at the same time make sure her daughter was provided for, this is a great situation for Sarah and for Judith. And Judith, believe it or not, we kind of used to joke about this when I did estate planning. It's called controlling your assets from the grave. Because Judith's going to make sure that her legacy goes and supports the land and people of Israel. She's going to make sure that she's making a difference in the world, but she's definitely not leaving her daughter out of it. And I think that a lot of people that I talk to, they have certain buckets, right? Everybody has perhaps, and this is just a rough generalization, they have a primary residence, they have some bank accounts or investment accounts, and most people have a retirement account. And most people's retirement accounts have been growing year after year. We were all encouraged in our 20s, put your money into your retirement account. And quite frankly, I think we all thought we were going to be able to pass that money, those assets, on to our heirs without jeopardizing their income tax brackets and pushing them up into the highest income tax bracket. And so I think that this gives you a great option for making sure your heirs are taken care of while you also make sure that you're leaving a legacy. This is just sort of a graph. You can sort of see, you know, the numbers. We're happy to share this with you. So if you want us to share the PowerPoint, there's going to be a thank you that goes out after the presentation, and we are happy to send this to you. I think I've just been noticing on the side, there have been several questions. Does somebody want to maybe pose some questions? Matt, Bill?
Yeah, and there's a few questions that we will follow up with individually, just because there's a few different parts to them that we want to make sure that we're understanding it correctly. But one of the questions, go ahead, Robin.
I was just going to say, one of the questions for the charitable gift annuity is, for the remainder balance, do you get an additional tax deduction? And the answer is no. You get the tax deduction in the year that you make the gift annuity. So that was a simple one to answer.
All right, wonderful. So then we'll go to, someone asked about the CARES Act, and when does that end?
So the CARES Act, and I think what that person's probably talking about is that you are able to deduct up to 100% of cash gifts, 100% of your adjusted gross income in 2020. And then the other thing that happens in under the CARES Act is you do not have to take your required minimum distribution this year, just 2020. You don't have to double it up next year. You just don't have to take it this year. And sort of the premise underlying that rule was to give the market a little time to recover before we had to start dipping back into the principal of our retirement accounts. And I do think, you know, the government's goal is to make sure people have enough to retire on. I just think that they made a conscious decision that these assets were to be used during the the originator's lifetime and not to be passed on into the future.
So just for a little added, because I think I saw that question written earlier, the benefits of the CARES Act, I get them confused sometimes, end in December. It's only for this year. It might be you know, no one never knows, right? So they might come up with well, let's stretch this out another year. That could happen. But as we know now, the 100% charitable limitation and the RMD exemption is for this year only. We'll see.
Cynthia, one of the questions came up. If you already have a beneficiary IRA, are you grandfathered in, or do you fall under the new rule?
So if you inherited your IRA before January 1, 2020, you are grandfathered in, and you do not have to worry about taking these distributions over a 10-year period. The Secure Act went into effect on January 1, and so anybody who passes away after that date and leaves the beneficiary as an actual person rather than a trust or gift annuity or et cetera will fall under these rules. And so, you know, it's funny because, you know, you constantly read about like celebrities who kind of mess up the, you know, their estate planning. And I'll tell you a story. I mean, I think everybody kind of remembers this one. Barry White, famous singer, had a lot of money and also had several relationships and 9 children. He was in the middle of a divorce from his second wife, but he never changed the beneficiary designation on his retirement account. When he passed away, he was in a relationship with his longtime girlfriend. They had a child together. And guess what happened? Because he never changed the beneficiary designation, the second wife, who he was in the middle of a divorce from, ended up with the money. And that's like a famous person, but I will tell you that that happens all the time. So it is something to think about, that you should probably revisit your beneficiary designations for all of your accounts, including your retirement account, at least once every 5 years. Just take a look at it.
What Cynthia says is really important, because we run into this all the time, that you are in complete control of your assets until you are no longer in control, meaning you pass or something. And if you had intended to leave someone a bequest, or change a beneficiary, if it's not done, then even if you tell them, and I write you and I said, you're going to be the beneficiary of my IRA and you're going to get this, if it's not written and if it's not properly documented, once you're gone, all bets are off. It'll go exactly to what they've got written. It's happened to us in a number of estates where, for whatever reason, the decedent never signed whatever he didn't sign, or didn't sign it properly, and whatever they had planned to do is no longer valid. It's only what they said they were going to do, which was in writing. So we always recommend that you every now and then pull those docs out and look at them and see if it's what you want.
Any other questions, Bill?
We've got a few more. For the unit trust, can you designate a part of your IRA to the unit trust and a remainder elsewhere?
Absolutely. Absolutely. You can do a percentage, which is the most typical. The other thing about the unit trust, the charitable remainder unit trust, is it's incredibly flexible. So we've had trusts where the first beneficiary was a 96-year-old woman. The contingent beneficiary over the term of the trust were a married couple in their 70s. And the second contingent beneficiary is actually the son, who's in his 40s. You really can make the CRT, the charitable remainder trust, work for you. It's something that absolutely can be tailored. The gift annuities are a little more rigid in the rules, and they're more highly regulated, I guess you could say. But the charitable remainder unit trust is quite flexible. You can add to it over time. You don't have to just have the first, principal amount, and that's the end of it. So they really can be used as a tool, a great estate planning tool, if you will.
And just for verification, they want to know that if the 401k is the equivalent or not for the IRA for this purposes.
It is. So the Secure Act applies to basically any retirement account, 401k, 403b, IRA, etc. One thing I do want to mention, because we didn't really talk about this, a lot of these rules are not rules, but a lot of these suggestions that we're making really are going to benefit beneficiaries that are more than 10 years younger than you. If you have a spouse that you're leaving your retirement account to, that is a whole different story. So I just want to make sure that I'm making that clear, because it's pretty important in terms of your spouse.
Great, thank you. And the last question we have here, unless anybody else has anything else, goes back to the charitable gift annuity and the deduction on the savings between, on the slide that's between the CD and the gift annuity. If we want to go back to that slide.
Okay.
There it is.
There it is.
One more.
One more forward.
One up, Robin.
This one?
No, the green. Yeah.
So then the question had to do with can you explain the tax savings of $4,296? Is that the year of the donation?
So if you are offered a tax deduction, of $11,611 in this case. Well, what you're saving really is what the government would have, what you're saving is the amount of taxes that you wouldn't have to pay on the income. So on 11,600, it's not 100%. You're only paying tax at a 37% combined level. So therefore, the difference between the 37 and the 11,000 is what your actually tax savings are, because we don't, we're not paying 100%. It is actually what the rebate is on the it's based upon your marginal tax bracket. So
Exactly.
I'm getting $11,000 as a tax deduction. I'm paying 37% in taxes. So my actual savings on that is 37% of the $11,000.
But again, it depends on your individual
Yeah.
financial situation. And that's why, these are for illustrative purposes only. And that's why we encourage people to meet with us individually for a confidential consultation, because everybody's situation is different. Everybody's needs are different. Everybody's goals are different. Right?
So in this example, if the donor was at a 25%,
It would be.
the number would be smaller. That means the tax savings would be smaller. That's all.
Okay. Are there any other questions?
So we're going to be sending these slides out. We're going to be sending a thank you out. If you want the slides, just flip us an email back and we're happy to send it to you. Additionally, this presentation has been recorded. So if you want the recording, we're happy to send that to you as well. Or if you have a friend who didn't get to see it, obviously please forward it along and give us a call. I mean, one thing I actually didn't mention, and I would like to mention, is that we handle as trustee a number of charitable remainder unit trusts and charitable lead trusts for that matter. And so we do at Jewish National Fund have the wherewithal and the support to draft the trust, to handle the investments, to handle the sale of the asset if there is an asset to sell, to then do the tax returns. We'll do the tax returns. You end up getting a K-1, which is the form that you would bring to your own CPA for your own personal taxes. And so not everybody is able to do that, but we not only will do that for you, we will not charge trustee fees. So if you are considering something like this, I hope you'll give us a call because we are just here to help.
Thank you.
Thank you. I hope everybody has a great day, and we really, really appreciate you joining us. We have our next presentation is Tax Savvy Tzedakah next Thursday, 1 p.m. Pacific time, 4 p.m. Eastern time, and you will be getting a reminder. Thank you.
Thank you all. Call us if you need us.
Bye-bye.
Bye.
During this time of social distancing, Jewish National Fund USA wants to help you feel closer to Israel. If you like today's call, join us for the next program in our series. You can get more information at www.jnf.org/on-demand. You can also stay engaged and connected by watching other great Jewish and Israel-related content at youtube.com/Jewish National Fund. Have a wonderful afternoon.